let's talk about making appropriate special order decisions. So what is a special order? Basically, from time to time, companies receive a one-time special order to sell its product at less than its normal selling price. So management needs to make a decision as to whether to accept or reject the offer. Let's talk about how we frame this decision. Here's a current budgeted production information for Premier Company. The company manufactures printers with a unit cost of each printer of $329.25. So you can see the costs are broken up by unit level, batch level, product level, facility level, and then totals. Here we have $658,500 in costs for 2,000 printers, and that's how we get the $329.25 per printer. You could see, Premier has excess capacity and is able to produce more than 2,000 printers. So we're going to talk about excess capacity again. What that means is that they have a capacity, how much they can produce, and if they have enough room left over to accept the special order, then they can consider doing it. Once you no longer have excess capacity, it means that you have to turn away current customers. So in this example, a foreign customer offers to purchase 200 printers at $250 per printer. The offer price is significantly below the unit product cost. If you were the manager of the Premier, would you accept this one-time offer? Well, let's look. Step 1 in the decision process is determine the amount of the differential revenue. So in our example, the differential revenue is $50,000. It's $250 that they are going to pay us times the 200 special order printers for a total of $50,000. Then we need to go back and look at the avoidable costs, okay? So if we go back to our projections, we'll see that unit level typically are always avoidable, all right? It means that if we accept the special order, we're going to have to pay those. If we don't accept the special order, we won't incur those costs. So the total of that is going to be the 90 plus 8250 plus 750 gives us the $180 here. Then there's two different costs in the batch level. 200 so we have 2,000 printers here. That means that there's 10 setups. So one setup is for 200 printers. Therefore, one setup worth of assembly and materials handling costs are avoidable for the 200 printers. We would not incur that if we didn't make the printer. So we have the assembly cost of $1,700 and the materials handling cost of $500. Going back to our budgeted cost, production level, we're going to have to incur these regardless of the special order, whether or not we do it. And then facility level, we're going to have to incur regardless if we do the special order or not. Therefore, we would not include these as avoidable costs. Now we look at a total contribution to income, which is $11,800. What this means is that if we were to accept the special one-time offer, we would earn an additional $18,800 to income. Therefore, we should accept the offer. We know that Premier has excess productive capacity. Assume that Premier has the opportunity to lease its excess building space and equipment for $15,000. Now would you accept the special offer? The $15,000 is an example of an opportunity cost. If we do the special order, we can't lease out the space for $15,000. So now we include that in our analysis for the special order. So we have the differential revenue, we have the avoidable costs, and then we include the opportunity costs. Now our contribution to income is a negative $3,200, and we should reject the offer because we would lose money on it. If the one-time special offer proved profitable, could Premier afford to sell all of its printers at $250? As you can see from our analysis, Premier would lose $146,700 if it priced all of its 2,200 printers at $250. Therefore, they can't afford that. And the reason for that is because the production level costs and the facility level costs are not avoidable when you're looking at the entire 2200 printers. It's just avoidable for the specific special order. In addition to the quantitative analysis or the financial analysis, we also need to consider qualitative characteristics. Should a company ever reject a special order if the relevant revenues exceed the relevant costs? Well, it depends. What do you think would happen if Premier's regular customers learned that the company sold printers to another buyer for $250 each? Most customers would ask for the same price, but we know that we can't sell all of them at $250. Special order customers should come from outside of the normal sales territory, and special order customers should be advised that the special price does not apply to repeat business. So you need to consider the qualitative characteristics and the impact on your current customers before you determine whether or not you want to do the special order, even if it is profitable. Here I'm going to pause before we move on to how to make appropriate outsourcing decisions, and we'll talk about that in the next video.